Okay, let's take a look at problem 4 and see what we have going on here. As a long-term investment, this company purchased 20% of AMC, so we have to consider that, for $400,000. So that's no significant influence. Okay, so then it says on the purchase date, the fair value and the book value were good. Okay. During the year, AMC earned net income of $33,000, distributed cash dividends of 25 cents per share, and at the end of the year, the fair value of the shares was $33,000. So, no significant influence, fair value method. So, let's go through. We purchased $400,000. Investment, $400,000. Credit cash, $400,000. The next thing, they earned $330,000. Well, if we're doing the fair value method, we don't need to do anything there, so we can just leave that blank. And then they distributed 25 cents per share. So 25 cents per share times 20%, because that's how much we own. Okay, we purchased 20% of 500,000 shares. It's 100,000. 25 cents per share. So we're going to get $25,000 in cash, and we're going to have $25,000 in investment revenue. And because this is an asset that we purchased, it's in our portfolio, and we don't have significant influence, at the end of the year, we have to mark to market. So the fair value at the end of the year is $433. We paid $4, so we have a fair value adjustment. And that we could mark that to AMC. That's the company that's related to. And we have unrealized holding gains and losses. This is that other comprehensive income we talked about the other night. $33,000. The next part of this question says, assume that significant influence was acquired. We assume that that was done by board members or something, because they don't tell us anything about buying any more stock. So, we bought the 20%, but now it gives us significant influence. So it still starts the same, 400,000. That doesn't change. Okay? But then, if you remember, the next thing it said, let me flip this back so you have this to refer to. The next thing it said here was that we had some revenue. This company made $330,000. 20% of that is ours. That's $66,000. So $66,000. Our investment goes up, and that's identified as investment revenue. Now, we also got those dividends. So we got $25,000 in cash, but that reduces the value of our investment, because that money they sent out in dividends, they sent us our money. We owned that money, $25,000. And because we're using the equity method, where we increase the value of our stock at the end of the year by the investment and decrease it by the end of the year by dividends, we don't have to do a journal entry. And if we were to look at this to see how much this were worth to us, our T account would look something like this. We bought it for $400,000. We got $66,000 was our share of investment revenue, minus the $25,000 in dividends, and that would be the value of our stock. 466 minus 25 would be 441. The equity method. Increased by our share of the revenue, decreased by our share of the dividends.